asset classes. We have stocks and bonds, two classics, of course, and anchors that are, very likely, like you noted, overvalued and maybe not necessarily a good time right now. While we're at it, what's your opinion about real estate?
Well, is that real estate with gold under it or real estate without gold under it?
We're going to get to gold. Let's go with no gold under
it. So income producing properties.
Yes.
Well, the same setup is, of course, it pertains to real estate as it does to stocks and bonds, namely a financial market that is in the throes of the valuations associated with rock bottom interest rates. So cap rates on income producing properties are, some of them historically low. There are exceptions, of course.
Yes.
But I would, at a very generalized 5,000 foot level, lump commercial real estate in with the other asset classes as being mainly uninteresting. Now, there are always exceptions, and to double back for a moment to bonds, we just in the issue of grants we published just the other day, we talked with some people who I think have some very interesting, very small, very illiquid, and slightly hairy bonds to suggest for individual security selection. These things are trading, some of them, at the stress levels for reasons that don't actually parse. The reasons don't seem to be, or to us, persuasive. We think they are value laden, but they are what you should call businessmen's risks. They are speculative grade. They, as I say, they are illiquid, rather small in market cap. But this is what is left over. So there's nothing to do. Value investors say, proverbially, there's always something to do. And indeed, there is always something to do. But that something, increasingly, is available at the fringes of markets and not near the centers. So if you're looking at, if you're a family office with a long investment horizon, and many do have that luxury, it's a self-earned luxury to be sure, but they have the luxury of a long investment horizon. They have also the luxury of being tolerant of the liquidity. If they've got long holding periods, they have to worry about trading out of something because a mutual fund investor is not going to like their quarterly results or their monthly results, or indeed, in the case of hedge funds, almost their weekly results. So a family office can perhaps avail itself of the illiquid and eccentric opportunities available on the fringes of some markets, but we ought not to deceive ourselves. These are times of very rich valuations broadly. And, I've been around for a few cycles, and what one finds after the peak, after things have turned down, is you come really to regret those securities, those funds, what have you, that you reached for because they were the cleanest, dirty shirt in the drawer, right? So, as hard as it is to suggest prudent, not as hard as it is easy to suggest prudence, caution, and liquidity at this point, but it doesn't make commandingly interesting journalistic copy, which is my line of work, and it makes rather a tedious prescription for people who are looking for something interesting and remunerative to do. Those opportunities are fairly thin on the ground.